Good morning, madam. Today we are going to present about auditing non-current asset. Before we begin, let me introduce myself and my group members. My name is Bhuvaneswari and these are my friends Muhammad Shahid, Nur Aslinda, Nur Alia Akila and Masha Azira. Definition of non-current assets. Non-current assets are basically the valuable resources a business owns that are expected to be used for a long period, usually more than 1 year. They are not meant to be sold in the short term like inventories or trading stock. Instead, they help the company run its operations and generate future economic benefits. For example, a factory machine is used for production, an office building is used for administration, and sometimes assets like property may be rented out to earn income. According to MFRS 116 Property, Plant and Equipment and MFRS 101 Presentation of Financial Statements, these assets are recorded at cost when they are first acquired. Over time, their value may decrease because of usage or age, which is why they are depreciated, amortized, or sometimes impaired if their fair value drops significantly. Non-current assets have several important characteristics. First, they are long-term in nature, which means they are expected to be used for more than 1 year, sometimes even 5 or 10 years, depending on the type of assets. They are not meant for quick resale like inventory or trading stock. Next, these assets provide future economic benefits to the business. For example, a machine directly produces goods that generate revenue, while a building indirectly supports operations by providing office space for staff. Other than that, non-current assets can be either tangible or intangible. Tangible assets include land, buildings, vehicles, and machinery, while intangible assets include items like patents, trademarks, and goodwill that, although not physical, still create value for the company. Apart from this, when non-current assets are first acquired, they are recorded at cost, which not only includes the purchase price but also any additional expenses needed to bring them into use, such as installation or delivery charges. Finally, these assets do not remain at the same value forever. Over time, they are subject to depreciation or amortization, which is systematically allocates their cost over their useful life, or impairment if there is a sudden drop in value. Unlike current assets, their purpose is not to be traded in the short term, but to continuously support the business and strengthen its operation in the long run. The non-current asset cycle shows the journey of an asset from the time it is acquired until it is finally disposed of. It begins with acquisition, followed by recording, use in operations, depreciation or amortization, impairment, and finally disposal. At each stage, there are supporting documents that act as evidence and ensure proper control. The first stage in the non-current asset cycle is acquisition, which is when the business decides to obtain a new asset. This stage is very important because it sets the foundation for all the other steps. The process usually begins with the supplier quotation, where the supplier provides details such as the price, specifications, and terms of the asset being offered. This helps the company compare different suppliers and make the best purchasing decision. Next, once management agrees to proceed, a purchase order is issued by the buyer to formally confirm the purchase. The purchase order acts as a legal document that specifies the type of assets, the agreed price, the quantity, and the delivery terms. Other than that, the purchase order also serves as an internal control tool because it ensures that the acquisition is properly authorized before any payment is made. By using these documents, the company can avoid misunderstandings with the supplier and maintain proper records for accountability. Therefore, the acquisition stage supported by quotations and purchase orders ensures transparency, accuracy, and compliance in the purchasing process. Other than direct purchase, companies can also acquire non-current assets through hire purchase or lease agreements. In a hire purchase agreement, the business pays for the asset in installments over time, and only after the final payment is made does ownership of the asset officially transfer to the buyer. This method is useful when the company cannot afford to pay the full cost upfront but still needs the asset for operations. Next, We have lease agreements where the business does not actually own the asset but is given the right to use it in exchange for regular rental payments. Leases are especially common for expensive assets such as buildings, heavy machinery, or vehicles because they allow flexibility without the burden of ownership. Apart from this, both hire purchase and lease agreement act as legal contracts that clearly state the responsibility of the buyer or lease, the payment schedule, and the terms of use. These documents not only provide evidence of the acquisition but also ensure the rights and the obligation of both parties are well protected. Therefore, through hire purchase and lease agreements, companies are able to access valuable assets while managing their financial resources more effectively. After the acquisition, the next stage is recording, which ensures that the asset is properly documented in the company's books. First, the supplier's invoice is used as proof of purchase, showing important details such as the cost of the asset, the date, and the payment terms. Next, the assets is entered into the asset register, which is an internal record that keeps track of each asset's information, including its description, cost, location, and estimated useful life. Other than that, the asset register also helps the company monitor depreciation and plan for future replacements. By keeping both the invoice and the asset register, businesses can maintain accurate records, prevent misuse, and ensure accountability over their valuable resources. Once an asset has been recorded, it moves into the operation stage, where it is actively used by the business to support production or administrative work. To keep it in good condition, a maintenance log is maintained to record servicing, repairs, and inspections, which helps ensure the asset continues to perform efficiently and reliably. Over time, however, the asset gradually loses value as it is used, and this reduction in value is accounted for through depreciation or amortization. A depreciation schedule is prepared to show how the cost of the asset is systematically spread over its useful life, ensuring that the financial statements reflect the true value of the asset each year. By maintaining both a maintenance log and a depreciation schedule, the company can demonstrate that it is not only safeguarding its assets during operations but also reporting them accurately in the accounts. Even though assets are depreciated over time, sometimes their value may fall suddenly due to damage, market changes, or technological advancement. In such cases, the company needs to perform an impairment test, and a valuation report is prepared by professionals to determine the asset's fair value and confirm whether an impairment loss should be recorded. Eventually, when the asset reaches the end of its useful life or is no longer needed, it enters the disposal stage. At this point, a disposal approval form is used to authorize the removal of the asset from the company's records, and if the asset is sold, a sales invoice is issued to record the proceeds. This final step ensures that the asset is properly written off and that the disposal is supported by valid documentation.
Hello, Assalamualaikum. My name is Muhammad Shahid bin Zulhazmi. My number matrix is 06D8023F1133. I will presenting about audit assertion for non-current asset. Firstly is existence. It is to verify that the non-current asset physically exists at the balance sheet date. For an example, inspect asset physically like building or machinery and compare with asset registered. Next is right and obligation. Confirm the entity has legal ownership or control over the asset. Example, review purchase invoice, titles, or lease agreements. And next is valuation and allocation. Ensure assets are recorded at appropriate cost and adjust for depreciation, impairment, or revaluation. Example, recalculate depreciation, review impairment indicators, and check fair value reports. And next is completeness. Ensure all non-current asset owned are recorded the financial statement. Example, trace from physical inspection list to the asset register to ensure no omissions. presentation, and disclosure. Ensure non-current assets are properly classified and disclosure comply with accounting standards. For an example, review financial statement notes for correct disclosure of costs, accumulated depreciation, and revaluation. And next is accounting treatment for non-current asset. Firstly is initial recognition. Record at purchase cost, including all costs necessary to bring the asset to its intended use, purchase price, installation, delivery. Subsequent measurement. Choose. You need to choose like carrying amount or revaluation model. For example, cost model. Carrying amount equals to cost minus accumulated depreciation minus accumulated impairment loss. For revaluation model, fair value at revaluation date minus subsequent depreciation minus impairment. Next is depreciation. Allocate cost or revalue amount systematically over useful life using methods such as straight line or reducing balance. Impairment. Review for impairment indicators. If carrying value are much bigger than recoverable amount, recognize an impairment loss. For an example, machinery is recorded at 500,000 ringgit Malaysia in the books. Due to market decline, its fair value less selling cost is RM 300,000. Value in use is 320,000. Recoverable amount equals to 320,000. We need to choose the higher amount. And lastly, for the impairment loss, it equals to 500,000 minus 320,000. It equals to 180,000. And lastly is recognition. Remove asset from books when disposed of or when no future economic benefit are expected. Recognize gain or loss as difference between disposal, proceed, and carrying amount.
Assalamualaikum, my name is Nur Haslinda. My matrix number is 06D8023F1019. Today, I will explain about accounting system and control activities that related to non-current asset. First one is occurrence and authorization. Purchases of non-current assets start with a request from the department. Then the request must be approved at the right level of management. For large asset purchases, may need approval from technical experts to confirm specification. For example, engineers may need to check and approve equipment specifications. Entities usually maintain an authorization table based on the size of capital asset transaction. For example, small purchases can be approved by managers, but big project must to go higher management. Disposal of asset also need authorization above the requesting department. Assets that are no longer in use must be identified because they may need different accounting treatment. For example, impairment. Next one is property records. Most of companies normally using software to maintain detailed asset records. The asset register or PPE ledger includes details such as asset description, location and ID number, date of purchase and cost, depreciation method, useful life, and salvage value. This proper classification ensures capital expenditure is not mistakenly recorded as an expenses. Third one is completeness. Completeness is to make sure all the capital asset and disposal are properly recorded, so companies carry out regular reconciliation between the asset register and the general ledger. The last one is segregation of duties. Responsibility should be divided between staff to reduce the risk of error or fraud in asset management. For example, one person approves purchases, another one will record transaction, and another safeguards the asset. Large companies with many transactions usually have a formal control process, while small companies with fewer assets may only need simple controls. That's all from me. Thank you.
Hello, my name is Nora Alia Akila. My metric number is 06D8023F1050. Today, I want to present about audit procedure and evidence. Firstly, we have existence. The audit procedure is inspect non-current assets physically, such as building and machinery, and compare with fixed asset register. Their evidence is, first one is physical inspection record, second one is asset register. Second one, we have right and obligation. Their audit procedure is check purchase invoice, the titles or lease agreement to confirm legal ownership. Their evidence is, firstly is purchase documents, second one is ownership titles. After that, we have valuation and allocation. Their audit procedure is recalculate depreciation, check for impairment indicators and review valuation report. Their evidence is, firstly depreciation schedules, impairment worksheet and also valuation reports. Second one, we have a completeness, which is the audit procedure is traced from physical asset list to asset register and financial statement to ensure all assets are recorded. The evidence is, first one is physical asset list and asset register. After that, we have a financial statement. After that, we have presentation and disclosure, which is the audit procedure is review financial statement notes for correct classification and full disclosure of cost, depreciation, impairment and revaluation. The evidence is, first one is financial statement notes and then accounting policies. And then we have initial recognition, which is the audit procedure is, firstly inspect purchase invoice, contracts and payment voucher to confirm purchase costs. Secondly is verify inclusion of all directly attributed costs such as installation, legal fees and delivery. After that, physically verify the existence of newly acquired asset. The evidence is supplier invoice, delivery costs and asset register documents.
Hi and hello, my name is Marsha Hazira and my matrix number is 068023F1053. I will be talking about audit procedures by evaluating the evidence provided or recommended to support the assertions and accounting treatments. Next on the following list, we have subsequent measurements. For the audit procedures, they have two. The first one is for cost model, which is cost minus accumulated depreciation minus accumulated impairment losses, which equals to recalculate carrying amount. And for the second one is revaluation model, which inspect valuation reports from qualified valuers and check approval from management. The evidences are fixed asset register, revaluation reports, and journal entries. Next from the list is depreciation. The audit procedures are review the depreciation policy and compare with applicable accounting standards from MFRS 116, which is recalculate depreciation for a sample of assets. It is to ensure method use, which is straight line and reducing balance, is correct, consistent, and appropriate. The evidences are depreciation schedules, accounting policies, and recalculation worksheets. Next from the list, we have impairment. The audit procedures are inquire about impairment indicators, which is market decline, obsolescence, and damage. Is to compare carrying amount with recoverable amount, which a high fair value costs less to sell and value in use. It is to review impairment calculations prepared for management. The evidences are market data, valuation reports, and impairment working papers. And last but not least, from audit procedures by evaluating the evidence provided or recommended to support the assertions and accounting treatments is the recognition. The audit procedures are inspect disposal documents, which is disposal invoices, scrap receipts, and sale agreements to verify that gain or loss is calculated correctly as disposal then proceeds to minus carrying amount. It is to ensure asset is removed from the fixed asset register. The evidences are disposal contracts, bank receipts, and fixed asset register updates. Thank you.